Good afternoon. Welcome to Restart Michigan with KPMG USMCA, How to Be Ready on July 1, Part 3 of a 3-part series. My name is Tabitha Mensch, and I am an engagement manager with the Detroit Regional Chamber in Mich Auto. Thank you for joining us for this session. The Chamber launched this series of webinars to help businesses across the state prepare to restart operations and return to work. I would like to thank our guest speakers, KPMG, for volunteering their time to share with us their expertise. Before we get started, I wanted to make you aware that all participants are on mute, but you do have the option to submit questions at any time during this webinar through the GoToWebinar control panel. Our guest speakers will try to address as many of the questions as time allows. I will now turn the webinar over to Andy from KPMG.
Good afternoon. We want to thank Detroit Regional Chamber and Mich Auto for allowing us this opportunity to provide KPMG's point of view on trade issues as part of the Restart Michigan Automotive Series. My name is Andy Doornaert. I'm a managing director at KPMG's Trade and Customs team in Detroit. I started my trade career in the 90s as an attorney and customs broker focused on NAFTA and other trade issues. Today at KPMG, I am helping several companies, including OEMs and suppliers, with the transition from NAFTA to USMCA. Joining me today is Rada, Gaynullina, a director from Trade and Customs focused on transformation and technology in the area of global trade. Her background includes assisting clients with determining and analyzing preferential country of origin for free trade agreements and determining the best way to implement trade management systems. Joining us also during the Q&A session will be Don Oleski, KPMG's National Drawback Lead. Based in Detroit, Don has over 25 years of drawback experience. Don is part of the CBP Drawback Working Group that was formed to deploy the new drawback rules, and she's a recognized leader in the duty drawback industry. So thanks for joining. So once again, this is the third and last session of our series. The first two focused on finding cash, tariff recovery, and avoidance. Today, we're focused on USMCA or NAFTA 2.0 or CUSMA if you're in Canada. So you know the trade talks were contentious if the governments couldn't agree to the same name. Today we're going to start out by talking through the background on the rules. And then we're going to get into some of the key modifications and the changes that will apply to many industries, but then particularly to the automotive industry. We're going to give you some ideas about compliance and how to apply GTM software to automate the process. And then we'll go through a readiness assessment. Are you ready? And what steps you can be taking to be ready for July 1. And we'll take time for questions. So once again, the USMCA goes into effect July 1. So a lot of companies are asking, well, what's the big deal here? I heard some of the rules are the same. Well, we'll just start with the state of Michigan. There's $36 billion worth of exports going to Canada and Mexico. And as we know, Michigan's manufacturing footprint is integrated with Canada and Mexico. The largest export would be transportation equipment, so that's no surprise, automotive parts, but also machinery and then chemicals. So as we're going to talk about, this will have a significant impact on the price that your customers may be paying in those countries that are receiving those imports if they do not qualify for USMCA. And if you're importing goods, typically the normal duty for automotive parts could be 2.5%, but could be as high as 25%. And it's not just the additional duty that you need to be concerned about. Many automotive companies and other of your customers have probably made it clear that they want their goods to qualify for USMCA. So there's going to be a pressure on suppliers to ensure that their goods meet the new rules. As we look at the rules in general, many remain the same. The basic rules of origin, A, B, C, and D. Where you have to really focus are what are called the product-specific rules. This is where you'll see changes in what's considered local content or regional value content or what are called tariff change requirements. So there's been major changes in certain industries, chemicals and pharmaceuticals, plastics, where the rules have become stricter to qualify. For steel products, there's going to be an increasing local content requirement that increases over time, and electronics, and there are new rules for digital trade and e-commerce. So you really need to know how these new rules will affect your goods. We're going to focus a lot of our time on the automotive industry for obvious reasons. And there's 4 basic requirements now that are going to apply to OEMs. The first one may sound familiar, the regional value content. It's increasing from 62.5% to 75%. So it's definitely going to encourage more local production, local sourcing. Then there's a new rule specifically to what they're calling core parts. So engines, transmission systems, steering systems. There's going to be a special local content rule for those particular systems. And there's also the labor value content requirement now. So this will be challenging to implement. It's a real accounting exercise to reach the threshold. And we'll go through that in a little bit more detail, but you're basically going to be keeping track of direct production work and what are the hourly rates that those employees may be making. And then there's a new rule again for 70% steel and 70% aluminum content. So as we go through, for suppliers, there's also going to be a significant impact. Their local regional value content is going to increase. And a lot of companies will not be able to rely on what's called the deemed originating rule. So this is one of the rules that the Trump administrative trade negotiators concluded was not acceptable, at least as far as in the automotive industry. And this was a rule that allowed certain parts that were not on what was considered the trace list, that were not considered essential to an automobile, to be deemed originating. So we've had some situations where we've been working with their suppliers and they may be 90% local content under NAFTA, but 10% under the USMCA rules. So there's going to be some surprises and companies have to get prepared for that ahead of time. And you can also see that automotive parts have been broken out into 3 categories. So you really want to know which of the 3 categories your products fall under, and each one has an increasing RVC percentage. Now I mentioned there's a requirement for core parts. So you'll see in the column on the right some of the names of the core parts. So once again, these are going to get special attention. The OEM will have to show that they reach a certain percentage for all of them, or at least as in an averaging formula. So there's going to be special attention to these particular parts for engines, transmissions, axles, suspension systems, steering systems. And then the other requirement you probably heard a lot about is this labor value content percentage. So the question you're going to have to ask yourself, if you're an OEM, do you operate a qualifying wage rate vehicle assembly plant? Or if you're a supplier, do you operate a qualifying wage rate production plant? So what does that mean? It means that the average hourly rate paid for direct production workers is $16 or more US, and then there's also the equivalent in Canada and Mexico. And this excludes benefits or bonuses. Now, why is this important? Well, some of you may have already received a request from an OEM or maybe another tier 1 if your employees who work on the line receive payment of $16 or more. And it's usually going to be a yes/no question. But once again, it can be a complicated formula. And people are asking, well, what does that mean? I mean, well, it's the direct production. So it's those employees that are working on the line, those that are manufacture the parts or maintain the equipment that are producing the parts. Now, these employees could work on the floor. They could sometimes work at a workstation or somewhere else. But it's what they do on a daily basis, which is going to be an impact. And it's interesting that the rules do allow some flexibility. It allows time for them to be, updating equipment, receiving job training, safety and production meetings. So some of these rules are going to require a deep dive into job allocations and what people are doing at certain times, and then bring it all together. And another point that should be made is it includes part-time workers and temporary workers, because the negotiators could see the loophole where if they only tracked those that were full-time employees, you could have a lot of contract workers on site that aren't accounted for. So it's all of those people who are contributing to the production of the vehicle. And then we also talk about the steel and aluminum requirement. So this involves direct purchases by vehicle producers. Now, in some cases, the production that's being focused on could be made by a supplier. Then, as CBP has been explaining, then there's a good chance that then they'll have to make sure that those companies are fulfilling the rules. So the requirement is that 70% of the steel and aluminum is purchased from US, Canada, or Mexico. And just recently, in the interim implementing instructions that have been made available by CBP, they've actually identified what goods that they're talking about that need the steel and aluminum. So at first, there was a concern by a lot of suppliers that they were going to have to start buying their steel and aluminum exclusively from North American suppliers. But now they have limited it to those producers who make major stampings for what they're calling the body in white or the chassis frame. So irregardless of the producer, it's important that they able to support that their goods have 7% qualifying steel or aluminum. And I just wanted to show this other slide that for heavy trucks, very same set of formulas, but the percentages are slightly different. So we talked initially about some of the qualification requirements for light duty vehicles and parts, but there's similar requirements now for heavy duty vehicles. Now, a lot of you are asking, what type of strategies can we apply now to increase our USMCA content? So we've got some rules here we can just briefly talk about. There's the de minimis rule, which means that if all the materials that you purchase don't necessarily meet what's called the tariff shift rule, it allows for you to have certain components from outside of North America, provided that they represent less than 10% of the value of the good. So it's an exception to that strict tariff shift requirement. And there's another rule called the intermediate material rule that becomes more applicable now to automotive suppliers because they're not so concerned about what's called trace materials. This allows you to consider what's considered self-produced schools as fully qualifying for USMCA. So for example, if you make a sub-assembly at your plant and it meets the rule of origin for that sub-assembly, you get to include the entire value of that good as originating. So that means that instead of counting the non-originating components in there, it'll roll up. And so that'll help your ability to qualify a particular assembly because your sub-assembly is now fully qualified for USMCA. And there's another rule called the accumulation rule, which means if you're working with a supplier whose goods may no longer qualify for USMCA treatment, you do get to include the value that they're adding at that plant towards your own calculation. In other words, if you can get a statement from a company that states how much value they're adding and production costs, which could be labor and overhead, you could include that in your own USMCA regional value content formula. So I could explain these in greater detail, but there are certain strategies that are within the agreement that allow you to increase your USMCA content if you're struggling. Now, a lot of companies are trying to figure out how to prepare for July 1st with the new certificate of origin or certification phases. Now, at this time, there's not a formal certificate form like there was for NAFTA, but Customs says that there has to be minimum data elements, and they're actually less than there was for the NAFTA agreement. And so these elements could be found in a invoice, but if they're not there, then the company should not be claiming USMCA on July 1. So a lot of companies are working towards that right now. They're trying to get that information from their suppliers. What's also new is that the importer can now sign a certificate for USMCA preferential treatment. So in the past, it was only from the exporting country. It could be the exporter or the producer, but now the importer can complete the certificate. Now, that creates more flexibility. You may not be waiting for your supplier to respond, but at the same point, it does create some risk because if the companies are letting anyone sign the certificate and the goods don't turn out to qualify, there are consequences. So I will at this time, we'll talk more about some of the other requirements in a bit, but I'd like to turn it over to Rada to give her an opportunity to talk about the transformation process from NAFTA to USMCA.
Yeah, thank you, Andy. Appreciate it. I think, speaking about global trade management systems, and frankly, technology is certainly one of the key elements, right, of the transition to USMCA. And over the course of many years, since NAFTA has been in place, right, companies have been using various systems, right, automation tools to manage their NAFTA program. And with the new USMCA rules, the changes will have to occur, right? We know that, and companies will need to kind of focus on migration of their systems, right? Whatever GTM systems that they have today. So what we wanted to outline is really the key buckets of those changes that you should be considering, right? And hopefully at this point, all of you who have the GTM system in place have already considered those points that we're going to mention. So, first and foremost, as Andy has already mentioned, rules of origin are going to change, right? So in the example of the auto industry, right, the originating kind of the content, the RBC is going to change from 65% to 75% gradually. There are certain requirements introduced for core vehicles, for originating content for steel and aluminum, as well as, labor value content, right, is a new, absolutely new requirement. So that's certainly interesting, right? So from the global trade management kind of modification perspective or transition perspective, if you will, the rules of origin will have to change, right, in order to comply with the USMCA rules. And so depending on the type of the GTM software that your company uses, you will either need to obtain those rules of origin and upload into your environment. Usually it's a testing environment where you want to test it out first, or you have your kind of GTM solution provider to deliver those, so kind of push those rules into your systems and to begin the testing, right? And you also want to make sure that you have the subscriptions to rules of origin set up, because we know that the rules of origin will be changing gradually over the course of quite a few years. So the second biggest bucket that I would like to highlight, going to the next slide, Andy. The second one is really, related to the GTM system configuration and modifications, right? So companies that run on platform-based or on-premise type of GTM software will require to make significant configuration changes to the systems, in order to comply with the new rules. And this will require new regulations set up, right? Transition from NAFTA to USMCA, upload of the rules of origin, reconfiguring the system in order to meet the new USMCA regulation. But there are certain, GTM cloud-based solutions that kind of provide more, I would say, flexibility in supporting these changes, since the configuration updates kind of will come in a form of a system upgrade or a so-called kind of plug-in to your system. And then you can, start qualifying your goods. So I think it's important to make sure that you kind of talk through with your IT department on how they are transitioning your GTM system, or work with your, solution providers as well. And the third bucket is related to certification of origin, right? And Andy just mentioned that USMCA does not require any specific certificate of origin form as does NAFTA. So pretty much USMCA claims can be made in a more kind of information type of the document, whether it's a commercial invoice or other form, as long as it has the required data elements. And the key point from the GTM system perspective, right, that you, as of July 1st, you shouldn't be generating any NAFTA certs and, generating any old forms with the NAFTA wording on it, right? And you want to make sure that you transition your GTM system to apply those changes that we're talking about, right, related to the USMCA. So, since we're really less than 1 month away from the USMCA to be in place, we're hoping that you should have started to kind of look into the new rules and changes as they pertain to your product, requalifying your goods under the new rules, and, essentially evaluating the impact of the transition and also making, these key changes to your GTM systems. So moving to the next slide, Andy. So what I wanted to kind of highlight here is, GTM system certainly speeds up the process and automates the whole process, right? And I think it's important to kind of talk through the key benefits and how it can support requalification process going forward. One thing to note is that FTA qualification process, pretty much, regardless of what GTM system you use, it integrates very closely with various supply chain processes, including purchasing, production, sales activities, and the GTM software can automate pretty much the entire trade agreement management lifecycle, including, supporting sourcing decisions, obtaining vendor certificates, performing origin qualifications automatically, right, based on the bills of materials and components and cost information, and also issuing the certificates of origin in support of FTA claims. So moving on to the next slide, the other point to make sure to talk through is the master data, right? And we know that master data is really cornerstone in trade compliance and FTA program management, frankly. Such information as products, bill of materials, manufacturing costs, procurement information, values at transactional level, they usually come over to your global trade management system from your ERP system, right? Or maybe multiple ERP systems if you use different. However, in most of the cases, such information as product classification and preferential status, rules of origin, right, that usually resides in your GTM system. So when it comes to requalification of the goods under USMCA, what every company should really consider is validating the core master data elements, right, including classification, costing information, to ensure you have the most accurate data to start requalifying your product under rules. And we've seen this, one of the major hurdles for companies that are running the FTA program on the GTM. So I just wanted to highlight this key point on the master data. And moving on to the next slide. So, once you kind of migrated your systems, right, from NAFTA to USMCA and made all necessary system modifications, what GTM can support you, right, is also in requalifying those process. And that process really starts with, classifying your goods, right, or maybe validation of current classifications that you have. And once you have your updated rules of origin, right, uploaded from the data content provider or, or if you're using it internally, if you have built your own rules in the system, pretty much the system then determines the components, their characteristics that are relevant for determining preferential origin and kind of performs these qualifications. So we talked about the key master data elements here. The next step here, right, is then once you kind of have your rules of origin uploaded and master data, right, kind of considered for qualification, the GTM will then apply an appropriate method of calculation, right? Whether it's a tariff shift or net cost or transactional value, right? Could be the minimus rule that applies to your product. So once you qualify your goods, then the results of your origin requalification will be most likely recorded in the product master or master record, right? Depending on the system that you that you use, and that information can then transfer to certificates of origin, right, and transferred back to your ERP system, and pretty much used throughout the supply chain processes. So, qualification process via GTM is very straightforward. It's very automated, assuming that you have accurate data in place to calculate your RVCs, apply tariff shifts to your finished product, and so on and so on. So we certainly, as I mentioned, have clients where master data becomes a major hurdle that, regardless of what GTM system you implement, until that data is cleansed in your ERP kind of feeder system, then you almost bring in inaccurate cost information, bills of material information to your GTM, and that can negatively impact your regional value content calculation, right? So I think it's important to have the data in place. And I think, to summarize, having up-to-date rules of origin, master data, regulatory requirements in place, as well as performing necessary modifications to your system can certainly ensure successful transition to your to the USMCA rules for pretty much any organization that's claiming NAFTA today. So with that said, Andy, I would like to kind of talk through the roadmap, and feel free to jump in here as well. So we've now talked about regulational aspects of the transition, right, as well as we've kind of talked through at the high level at the technology aspects of the transition. Let's talk through some of the key steps that are crucial to ensure an efficient transition from NAFTA to USMCA from kind of more operational perspective, right? Like day-to-day workload, right? What does it mean? So we kind of put together this roadmap together to highlight some of the key transitional points. Some of them, majority of them are kind of July 1st, and a few of them are post July 1st. So I think, first and foremost, the transition starts with the impact analysis, right? I mentioned that before. This includes pretty much reviewing new rules of origin for your product, which ones have changed, which ones haven't, right? Is there any impact, right? Maybe there is no impact, but assuming that all of you are OEMs, there is we know that there's going to be quite a significant impact from the rules of origin and qualification perspective. So I think it's also a good time to evaluate any potential sourcing adjustments, right, in your supply chain to potentially positively impact the RVC thresholds in calculations. The second step in this roadmap, what we've highlighted is to have a system in place, right? So you will need to make sure that you migrate your NAFTA system to USMCA, upload the rules of origin, right? Make sure that you convert the master data and everything what I've talked about just a moment ago. The next few steps, step 3 and 4, kind of focused on providing instructions to your suppliers and collecting supplier declarations, right, either with changes to previous NAFTA qualifications, right, or potentially obtaining confirmations that the rules haven't changed, right, under USMCA. So that's an important step in the roadmap, and you want to make sure that you reach out to your suppliers. And if you have a system in place, then you certainly can leverage the system to, issue new supplier declarations. And also, once you receive that information back, you can record data in GTM for useful qualification purposes.
Rod, I'd like to add here. I was just going to add to what with a lot of companies have been asking about whether or not they can rely on a NAC certificate from their supplier, because as you know, a lot of these certificates are completed at the beginning of the year for a blanket period of 1 year. So it is unusual for a free trade agreement to start midway through the year. So a lot of them have been confused and asking customs, is it okay? And customs position has been, if the underlying data remains the same, so the company still has support to show that it could qualify for the free trade agreement status, and the rules of origin remain the same. They've stated that at least for the next 6 months, they can self-certify. So what does that mean? Now that importers can comply with USMCA by completing their own certificate of origin, they can rely on NAFTA. Now, once again, there is some due diligence that would need to be performed. You want to make sure the rules of origin haven't changed. You probably want to make sure that the suppliers' sourcing practices are similar. But in the short term, Customs at least said that companies can at least rely on those representations. Now, as I explained earlier, in the automotive industry, this deemed originating rule went away. So a lot of companies who clearly qualified under NAFTA may not qualify necessarily under USMCA. So that's important to take into account. So it's going to be a balance. And once again, when you make that USMCA claim, you are making a claim that, one, that you know that it qualifies, and two, you've got some underlying documentation to support the claim too. So companies should proceed with caution there.
Yeah, that's a great point. Thanks, Andy. Important consideration for sure. Yeah, and frankly, as you mentioned, right, once on July 1st, that's when the NAFTA goes away and USMCA comes into effect, right? And what that means that for organization, right, that you now can actually should be ready to really file the first claim related to USMCA. And if you do have the system in place to run NAFTA, then this is the time when you should be switching to the new USMCA rules in your production environment and really start requalifying your product, right, under a new USMCA rules, perform solicitations, issuing certificates of origin out of the system. So I think those are important steps. So that's really at the high level, the roadmap. Andy, anything else you want to add here?
Well, I think this is where communication with their customs broker is going to be very important. Most companies rely on their customs brokers to make the actual declarations unless they're a self-filer. So brokers are going to have a certain standard as far as what they'll accept as a approval to rely on another company's USMCA certificate. So that's the dialogue that should start right now. What does your customs broker expect to have on file in order for them to claim USMCA on your behalf? You're relying on them.
Right. Exactly. Okay. I think we move into the QA session next.
Yeah. And Dawn, you're on the line. We'd like to ask you a question because you're an expert in duty drawback. Are companies able to claim duty drawback when they're exporting to Canada or Mexico?
So within NAFTA, when NAFTA was implemented in December of 1993, NAFTA implemented some drawback restricting and eliminating language. Unfortunately, that language did carry through to the USMCA agreement. So the restrictions on drawback within USMCA are for exports to Canada or Mexico. There's two primary types of drawback: unused drawback. So let's say you import a vehicle, you export a vehicle, and then manufacturing drawback. You import the component parts or raw material and pay duty on that, and that material is used to manufacture a vehicle that's exported. You may be eligible to claim manufacturing drawbacks. What NAFTA and now USMCA did is they restricted unused drawback on exports to Canada or Mexico, and you're forced to claim what's called direct identification. It can be done, but there's many extra hoops that you need to jump through in order to claim on those exports. But for manufacturing drawback for exports to Canada or Mexico for goods that were imported into the United States, manufactured in the United States and exported to Canada or Mexico, you're subject to what's called the lesser of two duties rule. So for example, if you import a component part into the United States and pay $10 in duty on that product, you manufacture a vehicle and then you export that vehicle to Canada, it's subject to the lesser of two duties. So if the vehicle enters Canada duty-free, the lesser of would be zero. Therefore, there would be no opportunity there. So there are still companies that are claiming exports to Canada or Mexico because they still do have an opportunity, but then some other opportunities no longer exist because of this free trade agreement.
That's really helpful. And just to continue on that, the same restrictions that apply to U.S. foreign trade zones under NAFTA will also apply. So the similar restrictions that you can't use another USMCA country as an export platform to avoid duty through a deferred duty program. So that's something to be aware of too. And something you said just I want to remind the audience, just because your goods qualify for USMCA or previously under NAFTA doesn't necessarily mean they always avoid the 301 duties that are covering goods from China. So we've had some situations where we've had companies who produce goods in Canada or Mexico. They actually qualified under NAFTA, but because there's a different standard for rule of origin for purposes of 301 duties, where it's called a substantial transformation. And if your goods if the components from China don't undergo a substantial transformation in China or Mexico, they could still be subject to that 25% duty if they don't qualify, if they don't meet that substantial transformation. So it's something to be aware of. Some people have got caught up in that. Is there any other questions, Dawn?
Sounds great. So there's no questions in the panel. I highly encourage you, if you have any questions, you can go ahead and type them into this panel. But since we don't have any right now, I have a few questions that we hear from a lot of clients. So they're pretty common questions, and a lot, companies are trying to prepare for USMCA. So one of the questions, this is for you, Andy, if a company doesn't get their USMCA certificate by July 1st and an importer pays the ordinary duty, can the importer get a refund from U.S. Customs?
Yeah, so there has been a change in the refund policy under USMCA. So currently under NAFTA, you get to avoid customs, duty, and what's called MPF. And I'll explain what MPF is, but it's merchandise processing fee at the time of entry. And if for some reason you don't claim NAFTA, you can go back and get the customs duty back and MPF, provided you file the proper documentation within 1 year after the entry. Under USMCA, MPF, merchandise processing fee, will not be refunded at this time. We've been told that it was a legislative oversight and maybe in time it'll be adjusted. But starting July 1, if you don't claim USMCA and you try to go back and get a refund, you're stuck with that merchandise processing fee, which is typically a minimum of $26 or a maximum of $508 on a per shipment basis. So in some cases, you might have a duty-free item normally, but because you didn't claim USMCA and you go back and get a refund, you're still stuck with that merchandise processing fee. So we could see that there could be a lot of finger pointing between the US importers and their customs brokers or even suppliers about who will bear that extra MPF when it cannot be refunded. So that could be a point of contention. So I think that's something to be planning for too.
Sounds good. Thank you, Andy. Rada, I have a question for you. From a GTM Systems perspective, do companies need to deactivate the NAFTA regulation and activate USMCA, or can they have NAFTA run in parallel with USMCA?
Yeah, that's a great question. I think I've heard kind of similar questions from a few of our clients. I think it's really from the regulatory perspective, right? It's really switching to the new free trade agreement, right? It's a new rules, it's a new free trade agreement. It's a different kind of regulation. From the system perspective, the way how I've seen different GTM kind of recognized, right, a new USMCA FTA, it's really as a new free trade agreement in the system. So I think, what companies should do, right, is certainly to transition to the new USMCA and, potentially expire NAFTA, right, or deactivate NAFTA, whatever, depending on what GTM systems they use. But I think some of the key considerations that I would outline to make sure that your company kind of check, right, before you deactivate or expire NAFTA is to make sure that you still, within your GTM system, that you still have access to the NAFTA records for your previous NAFTA records, right? It could be NAFTA certs that you have issued already for the past year, the vendor certifications, right, and current NAFTA certificates that are valid, as of today, or qualification analysis that's done. I think that will be super beneficial, especially when the audit comes or for the NAFTA recon process. I think it's important to make sure that you consider that and kind of work with your GTM solution provider or integration partner kind of to talk through that and make sure that you do have, you will obtain the history to all NAFTA transactions going forward once you have USMCA in place.
Thanks, Rada. That's great guidance. Andy, I have two more for you. The first one revolves around enforcement. How will customs enforce USMCA? Will they be performing any sort of verification review?
So the enforcement rules will be very similar as they were under NAFTA. So the customs authorities of any one of the three countries can inquire a claim and do what's called a verification and ask for the supporting documentation, which could be cost of bills, material, purchase, looking for underlying invoices to support how that company made that. So once they make that inquiry, it's up to the importer or producer exporter who is the certifier to prove that it qualifies. I should say in recent phone calls that for the first 6 months, customs will be flexible. They're talking about informed compliance instead of enforced compliance, which means, unless there's something terribly egregious, a company had no reason to believe that the goods qualified, they probably will not be issuing penalties. But they did make some things clear. They said in the first finding, CBP will deny preference to all importations of identical goods. So in the past, sometimes it would just be the entry that was isolated, but now they're talking about denying preference for all goods that were covered by the same blanket certificate and liquidate those entries automatically. So that means that if you had something in December that was questioned and it turns out it didn't qualify, all the goods for from December through January of that year would also be automatically disqualified. And they say if there's a second finding, second negative determination, and they start to see a pattern of misconduct, well, then they could deny the preference for all identical goods until compliance can be established. So, and these companies can also be subject to the penalties that you hear about for any imports that are associated with negligence, gross negligent or fraudulent behavior. So, and the importer will also be exposed now, as before they could say, well, I relied on a certificate of origin from my supplier, but if they made the declaration, there's going to be a higher standard that they had some understanding that it qualified.
Sounds good. Thank you, Andy. So my next question I think is a good final question, unless we receive any other questions. I don't know about you, but it seems like it was just mid-March, blink of an eye ago, and now we are already at June 4th. Well, July 1st is right around the corner. So my question is, how are companies preparing for that July 1st go live date so they are prepared and they aren't seeing any issues come July 1st?
Yeah, I can start just by saying a lot of companies were already taking steps ahead of time to do that comparison of the impact study. But what they weren't doing was reaching out to suppliers, because a lot of the suppliers wouldn't respond. They said, well, unless we know that USMCA is going forward, we're not going to provide you any supporting documentation. So now they are scrambling right now to get information from their suppliers, because that information is typically dependent to determine the eligibility for someone's own goods before they can qualify them. Like I said, there might be some flexibility if the rules are the same, but there's been a lot of focus in the next couple of weeks to try to determine how goods qualify. So I think we should probably wrap it up at this point because of the timing. But once again, we just want to thank the Detroit Regional Chamber and Ms. Otto for allowing us this opportunity to share our point of view. And if you have any questions, feel free to reach out to anyone on the team here. We'll be happy to set up a separate conference call to share our thoughts with you.
This is Tabitha Mensch again from the Chamber to wrap up today's discussion. Thank you to the team at KPMG for sharing your time and expertise with us. To all the participants, thank you for your time. You will soon receive an email from me with a link to today's discussion in case you want to review any of the information shared. Please visit our website at detroitchamber.com/COVID-19 for the upcoming schedules for Restart Michigan webinars and our teletown halls, as well as more valuable information and data to help your business return to work. Thank you for your time today. Have a wonderful afternoon.